Something just broke in the silver market. And I don't mean a technical level or a trend line. I mean the entire pricing mechanism that's been in place for decades just fractured into pieces. Right now, at this very moment, on January 2nd, 2026, there are two completely different silver markets operating on this planet. And the gap between them is about to expose one of the biggest frauds in modern financial history. In Tokyo, physical silver is trading at roughly $130 per ounce. In Kuwait, retail bars are clearing above $100. In South Korea, a single silver Philharmonic coin is changing hands near $100. Meanwhile, on your screen right now, COMEX, the supposed global benchmark for silver pricing, is showing 71.31 per ounce. That's an 80% premium between what people are actually paying for real metal and what the paper market claims silver is worth. This isn't a temporary arbitrage opportunity. This isn't a shipping delay or currency fluctuation. This is the physical silver market completely decoupling from the paper silver market. And when I show you what's happening behind the scenes with bank short positions, you're going to understand why some analysts are calling this the beginning of the great silver squeeze of 2026. Let me start with the numbers that matter right now, because this situation is moving fast. As I'm recording this on January the 2nd, COMEX silver futures closed yesterday around 71.31, after getting hammered nearly 15% this week from the December highs, near $86. The mainstream narrative is profit-taking, or volatility, or some other sanitized explanation that makes it sound like normal market behavior. But here's what actually happened. The CME Group, the parent company of COMEX, raised margin requirements on silver by $25,000. Let that sink in. In the middle of the biggest physical shortage in modern silver history, with inventories collapsing worldwide, they jacked up the cost to hold silver futures positions by an amount that forced mass liquidation of retail long positions. This is what's known in the industry as a paper smash. It's a deliberate weaponization of margin requirements designed to suppress paper prices, while the physical market is screaming the complete opposite message. And the timing? Less than 24 hours before China's new silver export restrictions officially went into effect on January 1st, 2026. Now, why would they do this? Why crush paper prices right when physical demand is exploding? Because the banks that are short silver, the ones who've sold hundreds of millions of ounces they don't have, are staring down the barrel of the biggest margin call in commodity market history. And that CME margin hike, that wasn't an attack on silver. That was a lifeboat for banks drowning in short positions they can't cover. Let me show you what's happening in the physical market, because this is where reality lives. In Tokyo right now, you cannot walk into a bullion dealer and buy silver for $71. The actual price, factoring in tight wholesale supply, shipping, insurance, currency chaos, and the growing certainty that the next shipment might not arrive at all, is between $120 and $130 per ounce. Kuwait tells the same story in a different language. Retail silver bars are priced around $100 and up. Not because merchants are greedy, because that's what it actually costs to pry physical metal out of a global supply chain that's seizing up in real time. South Korea, a single silver Philharmonic coin, 1 ounce of silver, trading near $100 on local precious metals exchanges. Meanwhile, Western financial media dutifully reports the COMEX price of $71 as if it means something, as if it reflects reality. Here's the truth nobody wants to say out loud. That $71 COMEX price is an accounting fiction. It's a number generated in a sandbox where almost nobody actually wants delivery. High-frequency traders and bank desks ping contracts back and forth in microseconds, congratulating themselves on price discovery for a commodity that, in their own venues, rarely has to be delivered in size. The result is a spot number that tells you more about how comfortable the banking system is with its own paper exposure than it does about the actual cost of securing a 1,000-ounce bar of real silver. Now, let me connect the dots on what happened over the past few weeks, because this is where it gets really interesting. On Christmas Day, physical silver prices in Shanghai shot past $80 per ounce. That's where the dominoes started falling, because when Shanghai, where actual industrial buyers source real metal, starts trading significantly above COMEX, it creates a massive problem for the paper market. When Globex trading resumed on Christmas night, silver futures gapped higher from $72 to over $74. The squeeze had begun. Then, on Friday morning, December 27th, something extraordinary happened. At exactly 8:30 a.m., major two big-to-fail banks tapped the Federal Reserve's repo facility for $17.25 billion in emergency liquidity. Emergency liquidity. Let me repeat that. Banks needed $17 billion in overnight funding on a Friday morning during a silver squeeze. As trading progressed that day, silver prices exploded 11% higher, rocketing from $70 to nearly $80. And then, at exactly 3:52 p.m. Eastern, 8 minutes before the market close, someone placed a $429 million bet on junior silver mining stocks. not just any bet. Call options on the SILJ Silver Miners ETF, the majority expiring in just 3 weeks. To put that in perspective, the entire market cap of CLJ is $2.67 billion. A single entity placed a directional bet equal to 16% of the entire ETF's market cap. After silver had already soared to nearly $80, 8 minutes before the close. This wasn't speculation. This was someone with inside knowledge betting that something much bigger was about to break. Now let me show you what's happening on the COMEX itself, because this is where the rubber meets the road. According to the most recent data, 17 non-US banks are currently net short 43,084 contracts of COMEX silver. Each contract represents 5,000 ounces. That's 215 million ounces of silver these banks have promised to deliver, but may not actually have. And here's the kicker. For the first time in recorded history, the 5 major US bullion banks have flipped net long on COMEX silver futures. They were short roughly 20,000 contracts. Now they're net long 773 contracts. The US banks closed out their shorts, they got out, they saw what was coming, and they evacuated their short positions. But those 17 non-US banks, they're still holding the bag. And according to industry sources, they're not just short on COMEX, they're reportedly short hundreds of billions of ounces via OTC derivatives markets, the dark, off-exchange positions that don't show up on any public reports. Let's talk about why this matters so much. Silver isn't like gold. Gold is primarily monetary. If you can't get physical gold today, you can probably wait a few weeks. Central banks can be patient. Silver is different. More than half of silver demand is industrial. Samsung needs silver to make smartphones. Solar panel manufacturers need silver to meet climate goals. AI data centers need silver for power management systems. When industrial buyers line up at COMEX saying, we need physical metal and we need it now, and there aren't enough ounces in the vaults to meet that demand, you get what's called a bank run. Except this time, it's not depositors lining up outside a retail bank. It's major corporations realizing the futures market they've relied on for price hedging can't actually deliver the metal they need to run their businesses. COMEX registered inventories, metal that's available for immediate delivery, are down nearly 70% since 2020. Let me say that again. The amount of silver available for delivery at the world's primary silver exchange has fallen by 70% in just 5 years. London vaults have lost around 40% of their holdings. Shanghai inventories have crashed to the lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. 1 month. That's the buffer between normal operations and a full-blown supply crisis. And then China flipped the switch. On January 1st, 2026, yesterday, China implemented new export restrictions on refined silver. Under the new policy, only large state-approved companies can export silver, and only after obtaining special government licenses. To qualify, firms must have annual production capacity of at least 80 tons, and credit lines around 30 million. These requirements effectively block hundreds of smaller and mid-sized exporters who have long served as key suppliers to global industrial users. And China controls roughly 60 to 70% of global silver refining capacity. When China tightens exports, global supply doesn't just shrink, it collapses. Now here's what makes this situation absolutely explosive. The silver market has been in a structural supply deficit for 5 consecutive years. Global demand in 2024 was roughly 1.2 billion ounces. Total supply? Around 1 billion ounces. That's a 200 million ounce shortage. And that was before the AI boom really kicked into high gear, before China's export restrictions, before the physical premiums went parabolic. The paper to physical ratio in silver is estimated at around 356 to 1. For every single ounce of actual silver that exists, there are 356 paper claims on that ounce floating around in the financial system. That works fine as long as everyone agrees to settle in cash and nobody demands physical delivery. But what happens when industrial buyers, who need real metal, not cash settlement, start demanding delivery? What happens when investors realize the ETFs they own might not be backed by the metal they think they own? What happens when countries start hoarding strategic resources? You get exactly what we're seeing right now, a complete decoupling between paper price and physical price. The paper market can print $71 all day long. But if you want actual silver delivered to your vault, you're paying $100, $130, or whatever it takes to find someone willing to part with real metal. This is what analysts mean when they talk about the great silver squeeze of 2026. It's not a short squeeze in the traditional sense, though there's certainly that element with the bank shorts. It's a physical shortage colliding head-on with a massively leveraged paper market that's built on promises nobody can keep. Let me give you the bear case, because you need to hear both sides. The argument against silver going significantly higher is that these premiums are temporary. High prices will eventually stimulate more production. Industrial users will develop substitutes, China will ease export restrictions when they realize it's hurting their own economy. The paper smash will succeed in cooling speculation. These are legitimate possibilities. Markets are unpredictable. Governments change policies. Technology creates new solutions. And silver has a long history of violent volatility in both directions. It's called gold on steroids for a reason. But here's the problem with the bear case. It assumes this is a normal commodity cycle. It assumes the physical shortage can be solved quickly. It assumes China's strategic positioning is about economics rather than geopolitics. It assumes the banking system can continue to suppress paper prices while physical markets scream the opposite. And the evidence increasingly suggests none of those assumptions are correct. This isn't a normal cycle. The supply deficit has persisted for 5 years despite much higher prices. New mines take 10 to 15 years to bring online. Most silver comes as a byproduct of other mining operations, so supply is relatively inelastic. There are no viable substitutes for silver in most high-tech applications. It's simply the best conductor of electricity on Earth. As for China, their export restrictions are part of a broader pattern of resource nationalism. They've done this with rare earth elements, with antimony, with gallium. This isn't a short-term trade policy. This is long-term strategic positioning for a world where critical minerals are weapons. And the banking system? That margin hike bought them time, but it didn't solve the fundamental problem. The banks are still massively short. The physical shortage is still real. And every day that Shanghai trades $10, $20, $30 above COMEX is another day that arbitrage doesn't close because there simply isn't enough metal to move. Here's what happens next, and I want to be clear. This is speculation based on market dynamics, not a prediction carved in stone. But if the current trajectory continues, we're looking at several possible scenarios. First scenario, COMEX loses its role as the global price setter for silver. Physical markets in Shanghai, Tokyo, and other Asian centers become the real benchmark because that's where actual metal changes hands. Western paper prices become increasingly irrelevant. This has already happened in other commodity markets when physical shortages emerged. Lithium and rare earths being prime examples. Second scenario, a major bank or financial institution fails a margin call related to their silver short position. This would be the modern equivalent of the Hunt brothers crisis in 1980, except this time it's not speculators trying to corner the market. It's a genuine industrial shortage exposing years of excessive leverage. Third scenario, industrial users start forward buying silver directly from miners at prices significantly above COMEX, creating a separate physical market that operates completely independently from futures exchanges. We're already seeing early signs of this. Fourth scenario, governments intervene. The US could release strategic reserves, change COMEX delivery rules, or impose position limits to prevent a full-blown crisis. China could ease export restrictions if they decide the political cost is too high. Multiple governments could coordinate to stabilize markets. The reality is probably some combination of these scenarios, playing out messily over months rather than in one clean crisis. Markets don't move in straight lines. There will be rallies and crashes, squeezes and releases, interventions and failures. But the underlying dynamic remains. Physical silver is getting harder to find while demand continues rising. The paper market built on that physical foundation is massively over-leveraged. And the gap between paper promises and physical reality is widening every single day. For investors, this presents both enormous opportunity and significant risk. Silver at $71 on COMEX might be the deal of the century if physical premiums continue widening, and paper markets eventually have to catch up to reality. Or it could be a value trap if governments intervene, industrial demand collapses in a recession, or the banking system successfully suppresses prices for another few years. For industrial users, this is becoming an existential crisis. How do you plan production when your primary raw material might not be available at any price? How do you hedge costs when the futures market doesn't reflect physical reality? How do you explain to shareholders that your factory shut down because you couldn't source silver? For the average person, this story illustrates something much bigger than just one metal. It shows how fragile global supply chains really are, how much our technology-dependent civilization relies on materials most people have never thought about, how quickly strategic resources can become weapons in geopolitical competition. The clean energy transition, the AI revolution, the push for electric vehicles, all of it requires massive amounts of physical materials: silver, copper, lithium, rare earths, cobalt. And we're discovering in real time that mining, refining, and distributing these materials at the scale we need isn't easy. It's not just about money or technology, it's about geology, geopolitics, and the physical limits of how fast we can extract resources from the earth. Right now, as I speak, there are two silver markets. One is digital, fast, liquid, and shows $71. The other is physical, slow, scarce, and shows $130. Which one is real? Both are real. But only one can deliver actual metal when you need it. The banks that are short know this. That's why US banks closed their positions. That's why someone bet $429 million on silver miners with 3-week options. That's why the CME raised margins in a desperate attempt to crush paper prices before the physical shortage becomes undeniable. But here's the thing about physical shortages. You can't print your way out of them. You can't use derivatives or financial engineering or clever accounting. When a Samsung factory needs silver to make circuit boards, they need actual silver. Not futures contracts, not ETF shares, not promises. Metal. And right now, that metal is getting very, very hard to find at anything close to the COMEX price. Where does this go? I genuinely don't know, and anyone who claims certainty is lying to you. But I can tell you what I'm watching. I'm watching the premium between Shanghai and COMEX. I'm watching COMEX registered inventories. I'm watching open interest for March delivery, currently standing at 118,000 contracts representing 600 million ounces, which is physically impossible to deliver with current inventories. I'm watching whether industrial users start panic buying and hoarding. I'm watching whether China expands their export restrictions. I'm watching whether other producing countries follow China's lead. I'm watching whether that $429 million bet on mining stocks pays off. And I'm watching whether the banking system can hold the line on paper prices, while the physical market operates in a completely different universe. This isn't financial advice. This is me telling you that something unprecedented is happening in the silver market right now, today. And most people have no idea because the numbers on their screens still say $71. But in Tokyo, in Kuwait, in Seoul, people are paying double that for actual metal. And that gap, that 80% premium between paper and physical, that's not just a number. That's the sound of a market breaking. The great silver squeeze of 2026 isn't coming. It's here. It started on Christmas Day when Shanghai crossed $80. It accelerated when banks needed $17 billion in emergency liquidity. It intensified when someone placed that massive bet on miners. And it entered a new phase when the CME desperately raised margins to suppress paper prices. What happens next will determine whether COMEX survives as a credible marketplace, whether banks can cover their short positions without blowing up, and whether the global financial system can handle the collision between infinite paper promises and finite physical reality. The only thing I know for certain is this. Silver at $71 on paper, while physical trades at $130 cannot persist indefinitely. One of those prices is wrong, and physics suggests it's not the physical one. If you found this analysis valuable, hit that subscribe button because this story is developing rapidly and I'll be covering every twist and turn. Drop a comment below with your thoughts. Are you buying the COMEX price or the Tokyo price? Do you think the banks can hold the line? Let me know what you're seeing. And remember, always do your own research. This is complex, fast-moving, and nobody has all the answers. But we're watching financial history unfold in real time. And that $80 premium, that's the market telling us something has fundamentally broken. Thanks for watching. I'll see you in the next one.